In this video, I'll be sharing everything you need to know about rolling covered calls, such as how you can roll covered calls and when you should roll. And if you follow this step-by-step guide, you'll be able to increase your profits while managing your losses. But before I start, do join my 8,000 members Telegram chat group to discuss or ask any questions that you might have. Alright, here's a quick recap for those who do not know what rolling a covered call means. Rolling a covered call just means that you are buying back your current covered call and selling a new covered call, all within one single trade. For example, maybe you sold a covered call on Apple 20 days ago at a strike price of $135 and you collected a premium of $2. During this time, the stock dropped to $110 and the option premium has dropped to 20 cents. So to roll, you first buy back this option by paying 20 cents to close the current option. Then you immediately sell a new covered call at $115 strike price, and by doing so, you collect a premium of $2.10. So if you add up all your trades, in the first covered call, you collected a premium of $2. Then you closed for 20 cents, then you sold another covered call for $2.10. In total, you collected a premium of $3.90. So that's an example of rolling a covered call, where you close the current covered call, then sell another new covered call. So there are three things you can do when rolling a covered call. First, you can roll your covered call out to a further expiry date. This is called rolling out. This will give you more days to expiry, and because there's more time, you will get more extrinsic value and hence more premium on your covered call. For example, a call that is 2 weeks from now at a strike price of $200 will have a premium of 36 cents. But a call 1 month from now at the same strike price will have a premium of $1.21. So that is rolling out a covered call, where you sell a new call at the further expiry date. The other thing you can do is roll up your call to a higher strike price, which also means you'll be selling further out of the money. By doing so, you will increase the probability of success, but it also means that you'll be collecting a lesser premium. As you will see later, this is a defensive move, where you typically roll up to avoid assignment. Lastly, you can roll down your call to a lower strike price. This means you sell the call that's lower in strike price, aka sell nearer to at the money. By doing so, there's a higher chance that the option will go in the money. But it also means that you'll be collecting more premium. This is an offensive move, where you typically roll down to earn more premium. Now, in the perfect world, every time you roll, you'll be rolling for a profit. But I know that's not possible, as the stock can surprise you and be like, surprise, Marty. So here are three scenarios on when you want to roll your covered call. Scenario 1. Your covered call has barely any value left. This can happen because either a lot of time has passed or because the stock has gone down in price. For example, maybe you have sold a 45 DTE covered call and within 7 days, the stock has crashed and the covered call premium has dropped to just 20% of its initial value. In that case, it doesn't make sense to continue holding the covered call for another 38 days just to earn the remaining 20% premium. So a better move would be to close the current covered call and sell a new covered call to earn another round of premium. Scenario 2. Your covered call is at the money. This happens when you sell a covered call and the stock moves up and touches your strike price. When this happens, you have two choices. One, if you are okay to let your stock get caught away, you can just sit back and do nothing. But if you want to keep your stock, you can roll out and up to a further expiration date and a higher strike price. That's because by rolling out and up, you get to collect another round of premium. But more importantly, you give your stock more upside to go. Scenario 3. Your covered call is in the money. This happens when the stock suddenly shoots up and breaches your strike price. Similar to the previous scenario, you can either do nothing and just let the stock get called away, or roll out and up to earn another round of premium and increase your strike price. Though in some cases, if an option goes too deep in the money, it may be too hard to roll without going further out in time. For example, the $175 strike price has a delta of 95 and the premium is now around $17. So if you want to roll out and up to collect a credit, you have to go all the way to 4 months later just to roll up by $5 and collect a $17.65 credit. This is quite bad, as the decay of far-dated options is quite slow. And at the same time, there's also a chance that the stock can continue to go up making it further in the money. Good news, Moomoo has just partnered with Nasdaq to launch Nasdaq Total View, a feature that gives deeper and more powerful insights into its listed stocks. This includes 60 levels of bid and ask, as well as seeing the bigger picture with 20 times the liquidity of a standard level 2 order book. With this, you can now uncover liquidity, demand and supply to better identify support and resistance levels with ease, thereby helping you to accurately forecast price trends as well as optimize the timings of your buy and sell trades. To enjoy this feature, new users can sign up with my link down below, and for existing users, you can open up your app, head over to Me, Promotion, then claim your 3 months free trial of Nasdaq Total View. After that, open up a stock that you want to analyze, click on the order book icon and make sure Total View is selected and you are good to go. Besides this new feature, Moomoo Singapore is currently offering some very generous promotions. First, you will get to enjoy a 6.8% per annum guaranteed returns for up to 30 days on your first 80,000 Singapore dollars invested with Moomoo Cash Plus. Though, please note that Moomoo Cash Plus is an investment product. This is not comparable and is different from savings deposits. Principal is not guaranteed and up to 30 days of 6.8% per annum is guaranteed only during the promotional period. Investment in any capital market products involves risk and a risk to lose principal. On top of that, you will be able to unlock up to 4 stock bundles of the top 5 traded US stocks worth $70 each and an Apple share worth $243. Plus up to $20 cash coupon exclusive rewards when you sign up using my link. So there's 990 Singapore dollars worth of welcome rewards in total. Holding period and buy trades applies. So if you are interested in taking your investments to the next level, do try out Moomoo Singapore. And with that being said, let's get back to the video. Once in a while, I have people asking me,
"Hey Kelvin, my stock has touched the strike price. Should I wait and see what happens? Or should I just roll now?"
For this, Tasty Trade did a study to compare different actions for when the strike is tested. And what they found was that rolling the option would give you the highest win rate and the lowest loss as compared to exiting the trade straight away or allowing the option to expire. Basically, it's always better to do something than do nothing. So here are 3 methods that you can use to decide when to roll a covered call. The first method is the 21 DTE method, where you just roll whenever there's 21 days left to expiry. You don't care whether it's in the money or out of the money. As long as it's at 21 days to expiry, you just roll. But what specifically 21 DTE? According to a study done by the Tasty Trade team, where they backtested selling options on SPY from 2005 to 2021, what they found was that at 21 DTE, there's a 76% chance that the trade is already profitable. But if you hold to expiration, there's a much higher probability of profit of 82%. So isn't it better to hold to expiration then? Well, not quite. Because while it's true that there's a higher probability of profit when you hold to expiration, both the average P&L of profitable as well as unprofitable trades goes up as well. Basically, when you are above 21 DTE, the volatility of the option is lower. And when you are under 21 DTE, the volatility goes up. So what's going on? That's because the closer you get to expiration, the higher the gamma. For those who do not know, gamma measures the rate of change of delta. Or in other words, it measures the sensitivity of the option price to the stock price. So since gamma goes up, as you get closer to expiration, the option also becomes more volatile. So in order to reduce the chance of the option going in the money, as long as it's at 21 TTE, you just roll. This will give you a slightly lower probability of profit, but it will also give you more trades that are more stable. The second method is to roll at 50% profit. So it's the example where I talked about just now. You sold a 45 DTE covered call and in 7 days, the covered call premium has dropped to 10% of its value. So rather than waiting another 38 days to earn the remaining 10% premium, you just roll your covered call to earn another round of premium. But obviously, you won't always get 50% profit in 7 days, right? What if you only get 50% profit and there's 7 days left to expiry? Or what if there's only 25% profit and there is 20 days left to expiry? Should you still roll? If you really want a complete set of rules, you can just follow this chart from Tasty Trade. For example, if you reach 50% profit within 14 days, meaning there's more than 2 to 3 weeks left to go, you can just roll. Or if you reach 20% profit in just 2 days, you can also roll. Or 40% profit in 7 days, just roll. Though, if you are too lazy to remember this entire table, just remember 50% take profit. But between the 21 TTE method and the 50% profit method, which is better? Again, Tasty Trade tested this, and what they found was that rolling at 50% would give you the highest win rate and highest return on capital as compared to rolling at 21 TTE. However, if you choose to only roll at 50% profit, you will also encounter a larger loss. In comparison, the 21 TTE method will see lower win rates, lower return on capital, but your losses are also more controlled. Here's the same thing, but shown as a graph. You can see that when times are good, the 50% winner method, the blue line here, will give you better profits. But during market crashes like in 2008, 2011 and 2020, the 50% profit method will see a huge dip since you are holding it through the crash, whereas closing at 21 TTE will see lower losses. So there's no right or wrong here, as different methods will produce different results during different time periods. But here's one more method, where you roll based on delta. So while the 50% method requires you to do a mental calculation of where the option is, the delta gives you a super easy way to tell where the option is. For example, an option that's a delta of 0.5 is at the money, below 0.5 is out of the money, and above 0.5 is in the money. So what does Tasty Trade have to say to this? They compared between rolling at 30 delta and 40 delta, and what they found was that if you roll at 40 delta, you have a slightly lower win rate, but in return, you will get higher P&L. This makes sense, right? Because the longer you wait to roll, the higher the chance it will go in the money. But because you only roll when it's closer to at the money, you will get to collect more credit. So which delta should you roll at? They mentioned that it's always better to roll your position when it's close to at the money as possible. So what this means is that when the option reaches 50 delta, you should roll out and up to avoid getting a sign. But at the same time, you should also roll when your option has very little extrinsic value left. For this, if the option goes below 10 delta, you can also take profit by rolling out and down. So that was the three methods you can use to roll. You can either roll at 21 TTE, roll at 50% profits, or roll when the option either goes above 50 delta or below 10 delta. Each time making sure that when you are rolling, you collect a credit as much as possible. But then, here's a question. What if the option goes too deep in the money? Is it a good idea to roll for a loss? In some situations, the answer is yes. For example, let's say I've sold a call option at $185 strike price and the stock was rallying all week long and my strike goes in the money. Then, if I believe that the stock can continue to rally upwards, in that case, I can roll out and up to $195, and by doing so, I paid $5 in premium. But by rolling upwards, I now gave the stock more room to go up by $10. Or basically, I gave up some extrinsic value to gain some intrinsic value. This is better than just doing nothing and capping the stock at $185. But of course, there's a chance that if you roll up, the stock starts going back down instead. So this depends on your outlook on the stock, yeah? If you feel that the stock can continue to rally upwards, you can roll up for a loss. Otherwise, if you feel that the stock may come back down, you can take a wait and see approach. So that was a quick video on how to roll your covered calls. Hopefully, you found this useful. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.